Today we're going over the House Blueprint, brought to you by taxreformnews.com. So what is the House Blueprint? The House Blueprint, or Better Way Forward Tax Reform Plan, was a proposal from the House Ways and Means Republicans. The blueprint was written in June of 2016, and the leader of the blueprint was Kevin Brady. Kevin Brady is a U.S. Congressman that serves Texas' 8th Congressional District. And one of the main tenets of the House Blueprint is the ability for the average American to be able to file their tax return on a postcard. How will tax reform occur? In order for tax reform to be passed, it must be initiated in the House. This is because the U.S. Constitution states that revenue measures must start in the House. There are differences between the current House Blueprint and the President Trump proposal for tax reform. What is the impact of tax reform on individuals? The House Blueprint calls for a change to individual income tax rates. The individual income tax rates would drop to 3 income tax brackets, down from 7 income tax brackets. The 3 income tax brackets would be 12%, 25%, and 33%. This would drop the highest individual rate from 39.6% down to 33%. Let's continue our discussion of the impact of tax reform on individuals. Now let's talk about capital gains, interest, and dividends for individuals. Interest, dividends, and capital gains would be taxed at ordinary income tax rates. There would be a 50% exclusion for this type of income, which would drop the effective rates of individuals down to 6%, 12.5%, and 16.5%. Capital gains and dividends are currently taxed at rates of 23.8%. Dividends can be taxed as high as 43.8% under current law. Now let's talk about the impact of tax reform on businesses. The House Blueprint would decrease the corporate tax rate to 20%. This would be a 15% decrease from the current corporate income tax rate of 35%. The House Blueprint calls for a tax rate of 25% for active pass-through income. Under the House Blueprint, the alternative minimum tax would be eliminated. There would also be no interest deduction on any future loans. Now let's discuss the impact of tax reform on international taxes. In order to raise revenue, there would be a one-time tax on foreign earnings of 8.75% for cash and cash equivalents. There would be a 3.5% tax on all other earnings. The details of this mandatory repatriation have not yet been released. Even though the details have not been released, Barbara Angus, who is the Chief Tax Counsel, stated on March 4, 2017, that the best source for what this might look like might be the former House Ways and Means Chairman David Camp's 2014 tax reform proposal. The Better Way tax reform plan would also repeal the previous Subpart F regime. And the blueprint would also have a border adjustment tax, which means that exports from the United States would not be taxed. Thanks for watching. Make sure to visit taxreformnews.com for more on tax reform. Please like this video if you have a chance. Also make sure to subscribe to our YouTube channel, Tax Reform News.